Andrew Stotz, host of the worst podcast investment ever. Hello and welcome to Talking Trading.
Thank you for having me.
Andrew, tell us about yourself. Where are you from? What is your background?
So I live in Bangkok, Thailand. Kind of a hardship posting.
Different.
I grew up in Ohio. I moved to California, got educated there, and went from California. When I was 26, I flew to Thailand. I sold everything I owned in America, closed my bank accounts, and got rid of everything, got on a plane, and arrived in Thailand at 26 years old in 1992 on my birthday. And I've been in Thailand ever since.
Goodness. What are you doing in Thailand? What do you do there?
So I have three, businesses that I do. First is I have a coffee factory run by my best friend Dale that we've co-founded, and that's about a 25-year-old company called Coffee Works. The second thing I have is a business called Stotz Investment Research, where we write research and provide research tools to financial institutions and the like. And then the third one is I have a company called Stotz Academy, where we help people create, grow, measure, and protect their wealth through online courses and teaching.
So what is your investment background?
So I studied undergrad in finance, and then I came to Thailand to teach finance originally, and then I got a job as an analyst, and I worked as an analyst for 10 years, and I worked as a head of research, running research teams for another 10 years.
Right.
During that time, I studied CFA to become a chartered financial analyst, which I became in 2001. And I volunteered with CFA Society until eventually I became president of CFA Society Thailand and represented the financial analysts and the financial community here. And then I did a PhD in finance, which I had an opportunity to do with a professor friend of mine in China. So at the age of 50, I came home to my mom and dad and said, I passed. Here's my PhD.
What was your PhD in? What was the topic?
Well, my topic, because I was a financial analyst, we're making forecasts all the time about the future. And my topic was, what is the performance of analysts' forecasts of earnings of companies? And try to objectively measure that across the world over 10, 15 years. And the answer to that question was about 25, meaning the average analyst forecasts that a company is going to make $125 million or whatever that number is. And in fact, the company ends up making 100. So they're optimistic by about 20 to 25%.
Really? How interesting.
Yeah. And it gives an idea of, first of all, we have to question the reliance on financial analysts. And it helped me also to put into perspective, because I've seen my own and other forecasts just fall apart. So the first thing it does is that. Yeah. The second thing it does is it helps us understand a positive bias that analysts have, which, there's a lot of incentives for that. But once you understand their positive bias, then you can adjust how you perceive what they're saying to you. There is some value there, but you just have to understand the underlying things behind it. And that's what my research really helped me to understand and help to reveal.
Positive bias. Okay, so let's jump into it then. You talk about 6 ways to lose your money and 6 strategies to win. I'm going to guess that positive bias is going to come into somewhere along here. Can we go through the 6 ways that people lose their money? Number 1.
Absolutely. So I'm going to just pull this up on my screen for a second for myself, just so that I've got it and I don't miss a one. And since I've been interviewing, so basically what I started a podcast about 3 years ago called My Worst Investment Ever. And I have people that I interview who basically tell me their stories of their worst investment. You kind of imagine, why do they do that?
Yes.
But by the end of it, almost every one of my guests says, I'm glad I, went through that. I hadn't really thought about that,
Right.
And it provides, if you're an academic and you're doing, one of the ways of doing academic research is to survey. Well, I do a survey. It's 7 simple questions. And from that survey, I have it recorded. It's up on my website, My Worst Investment Ever. And so from those surveys of 350 plus people, I was able to put together 6 common mistakes. So I call it 6 ways to lose your money and 6 strategies to win. So would you like to know mistake number one, the most common mistake?
I would love to know the most common mistake.
Yeah, like we could stop right here and you'd be really well off. And that is failed to do their own research. The number of people that put their money into things without any real research. And I say, to do their own research, meaning it's not just to, listen to someone else and all that. You've got to put your time into it. And it's just like food. If you don't do a little research to understand nutrients and the impact of carbohydrates and sugars and all that, you're going to suffer.
Okay, so here's a question. What about if the information that's coming towards the investor has a positive bias? It isn't actually accurate information.
And that's the challenge, that's when we start to get into the concept of research and what is it? Now, I'm gonna throw in here a little bit of my idea of how you overcome this. Okay. So basically, what I would suggest to anybody that's listening is that you just get a piece of paper, and on that piece of paper, you write down all the exciting, great things about this investment. Cryptocurrency is going to take over the world, and da 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 da. Write down all these. Or I think
property's going to double in value every 10 years.
Yeah. And why do we get into investments? We get into them because we see a rosy outcome. So write it down. On one piece of paper, write down all of it and the potential gains that you see. And then we know that, we tend to have a positive bias, and analysts in particular are incentivized to have a positive bias. So, but that we don't need to worry about that right now. Just write down all of them. Now, that leads us into the second most common way that people lose their money, and that is they fail to properly assess and manage risk. And so the second part of this is I want to encourage people to get another piece of paper. And this piece of paper, they're going to write down the risks. And from that, they can start to focus in and separate the research that they do on the return from the research that they do on risk.
And so that's fiscal risk and personal risk. Is risk divided up?
Yeah, that's there's all kinds of risks that we can put down. But let me give an example of my own business. In CoffeeWorks, my business partner, Dale, came to me and said, I want to expand to Vietnam. And so we said, okay. He said, I'm going to pull together. I'm going to go to Vietnam, meet with the different people. I see an opportunity for us to take over a particular business there. And I'm going to come back and we're going to talk about it. So we agreed that we would meet. And it was about 4 months later that Dale had everything pulled together. We sat down in the conference room at the end of the day, and he presented this, pretty rosy scenario of all the upside. And at the end of it, I had a lot of questions, okay, what's the potential? How much could it grow? What's coffee consumption? All of that. And then we ended the meeting, and we went and had dinner, and we had a nice conversation, and then we went home. Now, after that, we had agreed that the next week we would meet and talk about the risks. So a week later, we met in the same room, but this time we talked about the risks involved with this. And from this simple behavior, we were able to separate it was no longer a personal attack, of me saying, well, this and that. It was, he had to attack it himself as well as me. And all of a sudden, it just became so much more clear that, wait a minute, we have limited resources. We have this potential return in this part of our business. This is like a shiny object, but we didn't see the return for the amount of cost that we were going to put in. And therefore, we decided we're not going to expand. And that is an example in real life of how we can deal with, the first mistake, most common mistake, and the second most common mistake.
I feel like all investors should be listening to you right now. I'm so glad you're on Talking Trading. If anything, I wish you had come on here earlier.
Well, I think the main message to you, and this is critical, don't complicate it. I've been in the world of finance for years, and I say anytime that something gets complicated, something's wrong. Don't complicate it. Get a piece of paper, draw a line down the middle, or write on the front and write on the back, risk and return, or get 2 pieces of paper, but just sit down and write. Don't type, don't waste any time. Just have your cup of coffee and write it down.
How much does emotion play in this?
Well, now you're getting into mistake number 3, and that is driven by emotion or flawed thinking. This is where you start to understand we are not made for making investment decisions. In fact, there's a great book on this called Your Money and Your Brain by Jason Zweig. And that book really showed me that investing is a physical activity. I used to think it was like a mental activity, but I learned that the connection between the mental of what you're doing, coming up with a particular trade, and then watching the movement of that particular trade after you've put it in place triggers emotions that are very powerful, which trigger physical reactions in your body. Think about, have you ever, I remember one of my first days of working at Pepsi when I was young. I just came out of university in Los Angeles, and I reported to the factory, and I knew a little bit about computers, and I proceeded to go in and show off a little bit, and I proceeded to delete every file on the whole computer.
Oh dear.
And that moment when you just have sweat, like,
your stomach sinks.
Oh my God, I've just done something. Well, that's what I mean about the emotional. Luckily, I had a guy that helped me, felt sorry for me, and was able to reverse it. But the point was that emotional connection is big. And so we have to, once you understand that, then you can put some things in place to deal with that. So what I recommend to deal with this one is to find, explore, and list opposing views, and then discuss them with knowledgeable and objective people.
Objective people. That's the key word. Objective people.
Correct.
People who don't have a vested interest.
But they have an objective interest in you, and it's a great, and I just think that we get caught up in emotion, and, and when we do, we tend to make, now it's not to say, to talk about emotion, one of the things that I didn't really understand before I started the podcast was the difference between emotion and intuition. And I think I understand it a little bit better now. And that is, to me, intuition is this instantaneous reaction that's gone. It'll come for it's a flash. And most of the time we just override that with emotion, with our logic or something. But what I've really started to realize is that, trying to look for that instantaneous reaction and then putting some effort into bringing that up to consciousness, I think can really help us to not, stumble into mistakes.
The small, quiet voice, that inner knowing.
Exactly. And it's, it's not really emotion, and it's not really thinking. It's like this instant reaction. A great way of explaining it a little bit goes back to the book by Daniel Kahneman, which was Thinking Fast and Slow. And the way I describe it, and I haven't yet done this, but I really want to do this, is imagine that I get a rattlesnake. I put him in a glass box, and I cover the glass box with a what would it be? A cover for the, a cover for, that covers it up completely, a tablecloth.
Yep.
And then I get everybody to gather around. Come gather around. And then I whip off the tablecloth, and then they see this rattlesnake. They're going to jump for sure. Yeah. They're all going to jump.
Yeah.
And then their emotion and their mind, their logic is going to come in, but it's that instant intuition that is what moves them. And so I think that's a really important thing that I've learned from the podcast.
What's their intuition about the rattlesnake?
Well, it's just like this initial reaction.
Oh, okay.
Maybe you could call it reaction, but it's this behavior that is like absolutely is what's going to happen.
Because it's going.
You could also, another idea is that if you're up on top of a building and you are walking close to the edge, have you ever had that feeling in your stomach, like, whoa? It's like this woozy feeling, like, ah. And it's that. Now we overcome that with logic and reason and all that. But for that very short moment, there's this intuition, like, this is bad, this is risky. So don't be afraid to bring that intuition into your play.
Andrew, how much place does trust have in an investment?
It's kind of shocking, the number of people I've interviewed that just give their money away. They'll be like ruthless negotiators in work and business and this and life, and debating on Facebook or whatever it is. But then all of a sudden, some stranger comes along with a really great pitch. And next thing you know, they transfer $10,000 to their account.
Mm.
And basically, this is mistake number 4. And what I've seen is that people misplace trust. And so the way to overcome this, I say, is to get to know the person you're investing with and trust. Remember that there is no hack or short-term, there's no way to build trust except through seeing how someone responds in difficult situations. So I like to say that my business partner, Dale, and I have been friends for 35, maybe almost 40 years. And he's never once betrayed my trust.
Good friend.
And that is built over time. And I couldn't say that. I didn't understand the meaning of that, but I also couldn't really have the evidence of that. And I think, the same thing, if you look at the people that you truly trust around you, and that's why I teach an ethics class in investment and in finance, and I'm teaching it, in fact, this Saturday. And one of the things that I say to the young people in the class is, how many people do you trust? And I ask them to shout it out. And some will say 2, and some will say 3, some will say 0, some will say 5. But in the end, what I come up with is probably 2 or 3 people that people say that they trust. Now, they're surrounded by a lot of people. So that's right there, evidence that trust is rare. But it's the next question that I ask them that really gets them thinking, which is, so if I was to ask your friends who they trust, would you be the person? Because if you're not, then you need to build trust in your character. And that's part of a positive outlook on ethics, which I try to teach ethics in a positive way. How do we take confidentiality, diligence, trust, revealing conflicts of interest, these different things into our active daily lives and into our work, so that we don't look at ethics from a negative perspective of, look at this guy, he had a big reputation and then he lost it. Those kind of stories is just like a lecture, lecturing kids. But this is really trying to help young people rise up to say, you're going to be rare. And if you're trustworthy and you're implementing other basic ethics, you're going to become valuable.
It's beautiful. Monitoring your investment. How do you do that?
Yeah, so that's number 5, which is fail to monitor their investment. And this, I have a friend of mine, and I was advising him, helping him sell his business. And he was very busy as a CEO. And then one day, after we got to know each other, he asked me some questions about individual personal investing, and he was going to be making a lot of money from selling his business. So we sat down and talked, and I said, so what do you do now? And he says, well, let me just show you. And he opened up the bottom drawer of his desk. He said, every letter I get coming from my investment accounts and all the different things I do, I just put them in that drawer. Got 5 years of just, it's all in there, but I've never done anything about it. He doesn't monitor it. He doesn't follow it. And, what I always say is that you really want to have a predetermined, regular monitoring process. And a good example is if a friend comes to you and says, I want to open up a Lebanese, one of my favorite restaurants, a Lebanese restaurant, besides Thai, of course, since I'm in Thailand, but a Lebanese restaurant. I think it's a good location, and you think it's, a good idea, and the guy's got experience in it, and you do want to invest. And let's say that he says, I'm raising $100,000, and you say, I'm going to give you 10,000. At that moment, before you give him the money, I would suggest that you say, look, once a month, once the books are closed, I want to have a 1-hour discussion, pick the day, Monday, let's say, is the day that they're closed. So on Monday, once a month, I just want to get an update and demand that. And that will help you to, monitor that investment. And of course, the person will agree to it when you're proposing it, when they haven't gotten the money yet. You don't want to ask them after, because they may say, well, I already got the money.
Okay. Next one.
Now, the final one.
I have a brother in the Silicon Valley, so this is particularly pertinent.
Exactly. So the final one is kind of a catch-all. And basically, I've just seen a lot of cases of this, and that is invested in a startup company. And basically, what I've seen is that that's where people lose a ton of money. and a ton of time and energy.
Hmm.
And of course, we all go into it thinking it's going to be a winner. But the reality is that it's a very, very difficult thing to build success out of a startup. And so there's two things that I want to highlight here. First, I'd like to tell people, start from this reality. You're likely to lose everything.
Yes.
Once you've done that, now you know how much to allocate. Nothing wrong with taking 5% of your money and allocating it to a startup. But to take 75% of your money may be crazy. But you know what? The second thing I want to mention is that I decided a couple of weeks ago to go through all my episodes of people who failed in startups and see what were the common mistakes within this grouping. Would you like to hear them?
Yeah, I'd love to.
So number one, most common is bad hiring decisions. Number two, poor management of time and people. Number three, ineffective teamwork and collaboration. Number four, waiting too long to start selling. Number five, weak accounting and finance. And number six, low product quality.
Very
And
good.
there it is. Startup is such a fun, exciting thing, and everybody's excited about it. But if we go into it with the right mentality, we could stand a chance.
You know, what I'm getting from this fantastic interview is that just like share trading, that any sort of investing, it's fraught with problems because human nature is fundamentally emotional. And we all have the desire to get ahead. I wouldn't call it greed, but the desire to get ahead. And it distorts our decision making. Would you agree?
Yeah, it's totally true. And I think, yeah, it's not so much, I mean, certainly there's people that are motivated to get rich, but I'm motivated to win. And it's
nice.
particularly painful when that's not happening. And then it can force you into taking additional risk, because not only do I want to win, but I don't want to lose, and I don't want to be seen as losing.
Yes.
And therefore I'll go through some contortions to try to cover that up or whatever. And I think that's part of what I enjoy about my podcast, is that, right from the beginning, my pitch is, hello, fellow risk takers, and welcome to my worst investment ever. And I say that
Hello,
my name is
fellow
Andrew
risk
Stotz.
takers.
Exactly. My name is Andrew Stotz, and I'll be your worst podcast host for the day. The point being is that we start off right from the beginning talking about loss and mistakes and not being afraid to go there. And so, yeah, that helps.
Has everyone made investment mistakes?
No, in fact, I do get some people that say, I don't have any really serious mistake that I made. And then on the one hand, I say, well, consider yourself lucky and get away from me. You don't need me, and you don't need to be on the show. And, maybe we should be interviewing them. But the other thing I could say is that, truthfully, those responses may not be as accurate as they appear. And here's a great example. One of my online courses is how to start building your wealth, investing in the stock market. Very simple. It's not trading based. It's just that buying an ETF that owns every stock in the world, starting to implement that from a young age, can help you build up your wealth. So that's a very simple, thing. And basically what I try to just teach people is that it's the idea of contributing over time. And, what I've experienced is that people just get lost in all of their ideas, and then they never really get started. So, that's some of the way I've thought about it or dealt with it.
Andrew, you remind me of someone's favorite uncle, the sort of uncle that you wish you had, that you could talk to just before you start your investment, and you give all the savvy advice. Are you anyone's favorite uncle?
Well, I don't know about favorite, but I am their uncle. I have 5 nieces in my family, and that's where it originally came from, the idea of creating this course called How to Start Building Your Wealth, Investing in the Stock Market. The book's also on Amazon. And basically the objective was to help my nieces didn't have any interest in trading. In fact, they didn't have interest in the stock market. And in many cases, they didn't have interest in business. they studied politics and other things. So the point was, how could I get them to start saving and investing over time and building up? Could they have financial independence? And so that's why when each of them graduated from high school, I gave them each $3,000 and helped them set up investment accounts. In that case, they're in the US, so Vanguard was a pretty simple option for them. And then try to teach them how to go with it. And so that's really what I did. And I created the book and the course around that. And I learned a lesson too, which is that people who aren't really turned on by the stock market also need to be nudged to make a monthly contribution and to keep it going, because it's not enough just to put a little bit of money in an account and say, oh, 50 years from now, I'm going to be, super rich. You have to contribute on a consistent basis.
So what courses do you offer?
Well, I have, let's say, my focus.
Sorry, I don't mean to ruin your afternoon snack there.
No, I just ate a raisin. My focus is to help people create, grow, measure, and protect their value and their wealth. And so to create wealth, create value, is a course that I have called Finance Made Ridiculously Simple. And from that, I also have another course that follows on from that, how to make your company financially world-class. The idea being that majority of people, people are making big money through business. Now, the second thing about creating wealth is that now I've come to understand much more clearly that you can create wealth in a job. Let's imagine that you're paid $100,000 a year and you're spending, let's just imagine you're spending $40,000 in costs. The $60,000 is really wealth creation. And if you can then grow that wealth over time, now you move into the second place where I help, which is to grow wealth, and that's in the stock market. So I teach people, don't go into the stock market thinking you're going to create wealth. Go into the stock market to grow your wealth. And if you happen to create wealth, then they're also great. And that's the course, how to start building your wealth, investing in the stock market. Now, the next course relates to to measuring wealth. And for measuring wealth, I have the Valuation Masterclass. And that is a course that I've been teaching for 30 years and I put online about 5 years ago. And it's an intense boot camp for valuation, and it's company valuation. And it uses my financial models and my financial tools that I use for analyzing companies. And it takes about 150 hours. It's a tough as hell course. But by the end of it, a young person, let's say they want to be a financial analyst or work in the financial industry, or they really just want to become a value investor, they'll know everything they need to know about investing in stocks and valuing them. And then, of course, protecting wealth, the final part is the podcast, where that's more of a kind of a free thing where I go out and try to help people understand and think about protecting their wealth.
I got to tune into your podcast, the worst investment podcast ever. Sounds too good. Have you had your cup of coffee today?
I definitely did.
What flavor?
Well, I had Ethiopian yirgacheffe this morning, and I have some Cameroon. I've really been on a tour of Africa, so I've had some Cameroon, and so I've been enjoying different types. But that's the benefit of owning a coffee roasting factory, is that we get the good stuff.
Where can people go to get your courses?
So I have I'll send you the link, but if you just type in A Stotz Academy.
A Stotz Academy.
A Stotz Academy, or just Andrew Stotz, or go to my LinkedIn or any of those places and you'll see those courses.
Well, I hope you have a nice day over there in Thailand today, Andrew Stotz. Thank you so much for your time.
Thank you very much. I hope it was of value to everybody.
It was.